The global financial landscape is shifting as unexpected signals from Asia reshape economic dynamics. China, traditionally focused on economic cooperation with Japan, is now adjusting its priorities, which could have significant consequences. Tokyo has sparked global attention with its potential large-scale USD sell-off in 2025, signaling a fracture in traditional economic alliances and a shift in the international monetary balance. This raises important questions. Is the USD's dominance on the global stage weakening? The United Kingdom is reassessing its foreign policy approach toward China. Before his passing, Maloney made a personal visit to China, and positive developments are emerging from the Asia-Pacific region. However, these changes complicate the United States' position, especially as it tries to maintain a delicate power balance with Germany. Recent developments also suggest that Japan is adjusting its policies to better align with China, amid growing concerns within the G7 nations about potential influence from the Trump administration. One key development is the promotion of dialogue between Japan and China. Chinese Foreign Minister Wang Yi is expected to visit Japan in 2025. Over the past year, numerous positive steps have been taken to improve relations between the two nations, including China's expressed desire to work with the new administration under Japanese Prime Minister Kishida. During a visit to Beijing around Christmas, both sides signed an agreement aimed at rebuilding their relationship. This follows as China faces economic pressure from U.S. tariffs while Europe contends with its own strains due to controversial remarks, including those about Greenland. Another significant point is China's decision to lift the seafood import ban from Japan, imposed in August 2023. This ban had caused a sharp decline in Japanese seafood prices, with China accounting for around 23% of Japan's seafood exports, valued at $600 million. The restoration of this trade brings not just an economic boost, but also strengthens the bilateral relationship. Additionally, Japan has announced plans to relax visa regulations for Chinese tourists, extending the maximum stay from 15 to 30 days to boost tourism revenue. With China planning large-scale investments to stimulate its economy, Japan is eager to tap into this potential spending, particularly as Chinese consumers, especially the middle and upper classes, are known for their high spending levels. This trend is evident in luxury malls across places like Singapore, where Chinese tourists often shop with large bags full of high-end goods. Japan has already seen a sharp increase in Chinese visitors, with a 120% year-over-year rise in October 2024. China has become one of Japan's largest sources of tourism revenue, accounting for at least 20% of total earnings. As Japan faces economic challenges, especially with projections for GDP stagnation or even contraction in 2024, attracting Chinese tourists will play a crucial role in its economic recovery, bolstering foreign currency reserves and stimulating the economy. Meanwhile, China's consumer spending has surged in the past 4 years, with a 40% increase in luxury goods and upscale housing purchases, reflecting significant improvements in living standards. The real estate market is stabilizing. Both domestic and international spending, particularly from China, are expected to grow rapidly, benefiting countries that can effectively forge partnerships with Beijing. This shift in global economic power is no accident. G7 members are assessing their approaches to China, especially as the United States shifts toward a more isolationist stance, while China continues to push for globalization. Looking ahead, China's capital outflows are set to grow significantly in the coming years, driven by ambitious plans to issue $400 billion USD in special bonds by 2025 to stimulate the economy. These funds will be used for pension plans, insurance subsidies, and other welfare programs, unlocking increased consumer purchasing power. This strategy is vital for reducing China's reliance on the United States while expanding its global influence. With its current economic strength, China is uniquely positioned to achieve this without undermining its own economy. At the same time, Japan faces significant challenges from the global economic environment. If U.S. protectionist measures, particularly those under Donald Trump, continue, Japan could suffer severe consequences. Tariffs could harm key industries like steel and automotive manufacturing. A case in point is the steel agreement between Japan and the United States, which Trump had previously criticized, declaring that the U.S. would not allow its steel to fall into Japanese hands. Without policy changes under Joe Biden's administration or new mutual agreements, the likelihood of the steel agreement being terminated remains high. Japan's automotive industry is facing significant challenges due to potential disruptions from U.S. protectionist economic policies. In this context, Japan must adopt innovative strategies to maintain its competitive position in the global market and respond to growing pressures from the U.S. This is not only critical for the survival of key industries, but also has profound implications for the nation's economic stability and development in the coming years. Honda and Nissan are reportedly considering a merger to better compete against fierce competition from Chinese electric vehicle manufacturers, particularly BYD. Japanese carmakers are struggling to compete with BYD, which leads the global electric vehicle market. The situation in the U.S. is equally concerning, with Nissan experiencing a 2.2% decline in car sales during the third quarter of this year, despite U.S. restrictions on Chinese car imports. Honda has also been affected, reporting a 15% drop in profits for the second quarter, highlighting the substantial difficulties faced by Japanese automakers. One of the major concerns for these automakers is the potential for new tariffs. Under former President Donald Trump's administration, Japan's automotive sector, which heavily relies on the U.S. market, imported nearly 1.5 million cars from Japan in 2023, generating over $4 billion in revenue. Trump had previously threatened to impose a global tariff of at least 10%, which would significantly impact Japanese automakers. The North American market plays a crucial role, contributing 23% of Toyota's revenue, 30% for Nissan, and 34% for Honda. With such tariffs looming, Japanese companies may face the tough decision of either increasing production in the U.S. to avoid tariffs or reducing exports, both of which carry financial risks. Finding alternative markets for Japanese automakers is not straightforward, especially with Chinese brands like BYD gaining dominance in regions from Turkey to Thailand. The U.S. has been strengthening its trade barriers and promoting domestic manufacturing. Trump has emphasized plans to reduce the U.S. trade deficit with countries like Japan. In 2022, the U.S. manufactured goods trade deficit reached an unprecedented $1.3 trillion, with over $1 billion attributed to Japan. Should the U.S. cut imports, the flow of capital into Japan could decrease, severely impacting its economy, which relies on imports for manufacturing materials, oil, and food. This would likely lead to further depreciation of the Japanese yen, presenting an even bigger challenge for the country's automakers and economy. The yen has already lost over 30% of its value against the U.S. dollar since 2021, driving up import costs for Japan, including products from companies like LG. While Japan has taken measures to intervene in the currency market, the effectiveness of these actions remains uncertain. The Japanese government has warned that further interventions may be necessary. However, with Japan's public debt exceeding 200% of its GDP, it will be difficult to raise interest rates without exacerbating economic difficulties. Japan has spent nearly $100 billion defending the yen against dollar depreciation, and a similar scenario could unfold again. This trend is not unique to Japan. Brazil has also spent billions protecting its currency from collapse, highlighting the risk of a global currency crisis by 2025. The economic repercussions of U.S. protectionist policies, combined with Trump's trade wars, could weaken the U.S. dollar's role in global finance. These policies may reduce the demand for U.S. bonds, which could have far-reaching effects on international financial markets. Additionally, Trump's repeated threats to reduce the use of the U.S. dollar for international transactions have further strained global financial relations. In response to these economic pressures, Japan is increasingly cooperating with China. China has long promoted the use of its own currency in international trade, not just with Russia, but on a global scale. In 2022, bilateral trade between Japan and China reached about $43 trillion, over $330 billion. Japan has expanded its currency swap arrangement with China, allowing both countries to exchange local currencies up to $3.4 trillion, approximately $30 billion. This growing collaboration could have significant implications for the future of the U.S. dollar in international trade. As Japan seeks to defend the yen and manage its economic challenges, it may need to reduce its holdings in U.S. Treasury bonds, currently exceeding $1 trillion. Meanwhile, China is strengthening its influence on the global stage, which, combined with the U.S.'s increasingly isolated position, will likely lead to a decreased role for the U.S. dollar in global trade. This situation offers a glimpse into the potential consequences of Trump's trade policies. They could not only weaken the US dollar, but also create a chain of economic conflicts with unpredictable outcomes in the years ahead. Japan's export growth slowed significantly in August, with shipments to the US declining for the first time in 3 years. Furthermore, machinery orders fell unexpectedly in July, signaling a slowdown in economic recovery. Analysts have pointed out that weak external demand is hindering Japan's efforts to achieve sustainable growth, particularly as recession risks continue. Japan's export activity is facing significant challenges due to slowing growth in its two largest trading partners, the US and China. While total exports rose 5.6% year-on-year in August, this was below market forecasts and the previous month's growth. Exports to China, Japan's largest trading partner, increased by only 5.2%, with the overall volume declining for the 7th consecutive month. August also saw a trade deficit of $695.2 billion. The Japanese government's assessment of machinery orders indicates a stalled recovery, although personal consumption helped the economy rebound in Q2 2024. However, this growth was downgraded, reflecting the recovery's fragility. Business confidence among major manufacturers declined in September, with weak demand from China a key concern. Future recovery is expected to rely more on consumer spending than exports, with little expectation of a boost from overseas sales. The Bank of Japan is likely to maintain its current monetary policy in the short term, but may signal future interest rate hikes while aiming to maintain inflation around 2%. Japan faces several economic challenges, including potential trade disruptions, currency instability, and declining exports. These issues could significantly impact the country's future and its ability to navigate the changing global economy.